So we have different users out there, internal, external, and they need different kinds of accounting data. And our accounting data here, our financial reports, use items listed in the upper right-hand corner. And the accounting world has come up with some generally accepted accounting principles. Pronounce that GAAP. And GAAP has been developed over a period of time. It can be influenced by financial accounting standard boards and other regulators. Congress can influence it. But it is the general body of knowledge and general body of concepts that accountants use on a daily basis. SEC is involved in influencing accounting principles, the Financial Accounting Standards Board, the International Accounting Standards Board, and probably this international one has gotten a lot more important in the last 10 or 20 years as almost all of the big companies have become global competitors. It's not just they're not just players in the U.S. They compete around the world. One of the real fundamental general accepted accounting principles is the cost principle. And the cost principle says that we record assets when we buy something. We record it on our balance sheet at its cost, and we don't change it. Just because the price has fluctuated, we're going to keep it on our balance sheet at what we paid for it. It's easy to verify. Market value is subjective and can be manipulated. And imagine companies who bought land back in the 1920s or 30s, and they still have it on their balance sheet. Obviously, it's gone up in value, but the accounting world has decided that it's better, less subject to manipulation, to leave things on the books at what they were paid for. There's a monetary unit assumption. We're only going to record items that can be recorded in terms of money. And we may have some other things that take place, and we might want to try and estimate what they're worth, but if we can't apply a financial dollar thing to it, then there's no way to record it. And then the economic entity assumption. And this is really an issue with small businesses. Say that I own a auto body repair shop. That's a sole proprietorship. I own it. Lots of times people will run a checkbook and they'll write both personal expenses out of that checkbook and business expenses. And the economic entity assumption says that we just want to do the accounting for the business. So we're just interested in the things that relate to my auto body shop, not the other things. So we need to pull those out. We'll break out here proprietorships, partnerships, and then finally corporations. But a lot of businesses are proprietorships, could be sole proprietorships. They tend to be small, and the owner is responsible for everything. Then you have partnerships, and we don't see many partnerships. I mean, there are some, but not many. I always tell people going into partnership with somebody is a good way to lose a good friend. And finally, we have corporations, and those are legal entities set up by states, and corporations actually become people. They have the same rights under the law that people have.